Welcome to the Mink Market Education Introduction to the Stock Market course. As you can see by the list of courses or topics we've got here, we're covering a very broad range of different topics. If at any point you've got any questions, feel free to send through emails or contact us via the website. But what we're basically trying to do here is very briefly cover a vast array of topics and over the next couple of months roll out a whole series of tutorials and seminars that focus on each of these individual aspects of trading and investing in the market in a whole lot more detail. So I hope you really enjoy the course, and as I said, feel free to jump onto the website or send through some emails if you've got any questions or would like more information. So what is the stock market? Well, the stock market is where investors come to buy and sell shares in its simplest form. The ASX, or Australian Stock Exchange, was formed in 1987 to replace the trading floor or open outcry system. Now computers do all the work for the exchange. It's created a very efficient system for the exchange or the buying and selling of shares. With all the technological advancements in trading systems and platforms, we're now able to trade a whole range of products, including options, equities, CFDs, warrants, futures, FX, all on the one trading platform, all on the one computer, and from your own home. So there's no need for this open outcry system. Shares are a way for a company to raise capital to finance its business operations. By going public, a company lists on the stock exchange by issuing shares. When you buy a share, you're giving the company funds in return for part ownership of their business. You're now essentially a shareholder of the company. Now, each time a share is bought or sold in the share market by an investor or an institution or whoever it might be, you're not actually funding the company because you're trading with other shareholders, so you're only exchanging with another shareholder itself. Funding company's operation only occurs when a company first lists through an IPO or raises capital through a share purchase plan, placements or rights issues. In these cases, investors are buying shares directly from the company itself and therefore funding their operations. As a shareholder, you have certain rights and responsibilities, including the right to vote at companies' general meetings, receive reports and information, the right to participate in rights issues, corporate actions, buybacks, and also the right to receive dividends. So why do companies issue shares? Companies have two options when raising capital, and these are to fund through debt or to fund through equity capital in the share market, for example. Now, borrowed money must always be paid back, and you must always pay interest on borrowed money. Share capital, however, it doesn't actually need to be paid back. If you're a shareholder of the company, to get your money back, you're going to sell it to someone else who wants to become a shareholder, rather than actually getting your money back from the company itself. So shareholder capital or share capital doesn't need to pay back. It doesn't have an interest component. However, they may pay out a dividend, which does essentially is paid out of companies' profits. Generally, issuing equity capital is far more expensive than debt capital to a company. However, debt capital is far higher risk because you're at the mercy of the banks and the institutions that have funded you the money. Compare the difference for a company going through difficult times, for example. A company with high debt and low equity would be required to continue to repay interest and service this debt despite the condition the company's in. Banks may even require further collateral or charge more interest because of the increase in risk of funding you or funding this particular company. Compare it to a high equity, low debt company where they can simply cut dividends and repay nothing to shareholders. In this scenario, the actual company itself is exposed to a far lower level of risk. To summarise, essentially what we're looking at is a company who issues shares essentially passes on this risk, or a lot of the risk, to the investor. So how do companies issue shares? Shares can either be bought on an IPO as a primary issue from the company or on the secondary market on the ASX. Shares bought on the secondary market can only be bought from someone selling. Established or already listed companies can issue shares too. They do this via rights issues, share purchase plans, and basically what they're doing is they're re-offering shares to the market at a particular price. Quite often to do this, they will need to discount their shares and offer them for less than they're currently trading on the market. Now, this opens up quite a few potential trading opportunities, which we'll discuss at a later date. It's important to note that there is always a finite number of shares on issue, and this number doesn't change. Although companies may choose to go out and issue more capital, there is a fixed number of shares on issue. Now, the market capitalisation of a company is the number of shares multiplied by the current share price. Market capitalisation is something that's used to compare the size of a company. Now, many people will use the actual share price when comparing how large a company might be, and this is really very useless. Essentially, you need to compare one company's market cap to another company's market cap. Look at something like BHP and Rio, for example, where the share price of Rio is almost double that of BHP. And of course, the market caps do not vary by a similar amount. So it's very important to look at the market capitalisation when comparing the size of two companies rather than the individual share price. So why would you buy shares? Well, essentially, look, you're doing it to make money. There's no other reason to go out and buy shares than to grow your wealth. Now, as companies grow, obviously share prices appreciate or increase in value, and this is where our value in our investment comes from. Companies also pay out things called dividends, which sometimes are very attractive and include a franking credit or a tax paid portion as well. This is where the company goes and actually pays the tax at the corporate tax rate on your behalf. So, very beneficial and something to certainly consider if you're interested in the income part of investing. Now, shares are actually one of the very few extremely liquid investment products. So you can essentially jump into a share and out of a share in a matter of minutes. Whereas you compare this to something like property, for example, where obviously you have significant costs of entry and exit, and also obviously a long time frame as well. Some people utilise this and invest intraday or very short term, generally traders. However, some people hold almost forever. Portfolio investors, where they're looking for perhaps an income play or not looking to crystallise that capital gains tax and hold the portfolio eternally. An investor will go and buy issued debt for a known return without any capital appreciation, whereas with shares, an investor will go and buy issued equity for an unknown return, however, an unlimited capital growth upside. So what makes shares increase or decrease in value? Essentially, this is determined by supply and demand. However, a deeper analysis would focus on sentiment and fundamental analysis. To explain how supply and demand moves prices, consider this following example. If a company, say XYZ, has a small number of buyers and a large number of sellers on the bid and ask spread, sellers must compete with each other to sell their shares. In doing so, they're effectively pushing the share price down lower and lower. Why would people do this, or why would shareholders do this? Well, there are many variables at play. There could be, let's say, some sort of technical analysis where a chart is indicating a stock's reached its highs, it's reached a resistance level, and there's a lot of sellers coming into the market to offload their profits. There could have been some news released overnight or very recently, which has potentially had an impact on the company's future earnings. There's a whole range of factors that could be at play here. This is what stockbrokers analyse on a day-to-day basis to analyse where a share price might be going from here and why it's moving in a particular fashion. Using all this information, we look to take advantage of any potential opportunities by predicting the future direction of the stock. So what are some of the differences between shares and other types of investments? It's important to consider the worst case scenario, and analysing what happens in the case of bankruptcy. You must remember that shareholders receive their funds paid back last, so you're always going to be in a less risk situation in a debt investment where you're paid back any of your funds first. The other thing to look at is shares can be quickly and easily bought and sold, whereas things like property are very illiquid and very hard to trade. The other thing to consider is your size of your investment. In the stock market, investments can be as small as $500 right through to many millions.